Valens Research, Uniform Financial Analytics.
Cintas, for those of you who don't know, is a uniform supplier. So people rent uniforms from Cintas for everything from janitors to anything else in the world. It's an incredibly boring business, as you would assume, that would appear to have not changed significantly over the last couple of years. And as reported metrics would tell you that. As reported metrics would tell you that Cintas is basically the exact same company it has been for the last 15 years and way back before that, because as reported ROAs have been basically flat over that period. In reality, what we can see for Cintas is something very, very different. Returns have actually been expanding massively as the company has gotten bigger and scaled into the business, and as they've been able to drive higher returns. And that's important too, because when you look at an as reported PE for Cintas, you see an as reported PE of 32 times. Right? That's incredibly high levels, especially for a company that's had flat ROAs and really not that much reason to have optimism for this company because it's a boring, steady business. But when we look at the uniform accounting metrics, what we can see is actually this company isn't trading at a 30 times multiple. It's trading at around a 20 times multiple. Not cheap, but all of a sudden valuations aren't that excessive. And when we understand that market expectations are not that excessive for a company that also has had steady expansion of ROAs, all of a sudden this starts to make sense and even isn't outlandish. For instance, let's say we think that Cintas, there's something structural going on here for Cintas that means they're going to be able to continue to expand these ROAs. They didn't just level up and ROAs are going to plateau here like analysts are forecasting. Well, if we expect that to be the case, so we expect just like ROAs jumping up from 15 to 25, we expect them to go to 35%, right? All of a sudden, this company isn't fairly valued here, right? This company could have 30+% upside. But the question is, and this is what's so powerful, once you're looking at the real numbers, we can realize this isn't a company that I should just walk away from because it's overvalued. We can realize this is a company that actually, hey, the market's not out of line for the company. It's trading around market average valuations. I should maybe look at whether or not this company can continue to do what it did in the past going forward. And I can put in context and ask, okay, what are the questions I need to ask to understand if I think this company is undervalued or overvalued? And the questions we need to ask to understand that is, what has the company been doing for the last 5 years? And why is it that analysts think the company can't keep on doing that going forward and is just going to see returns plateau? It's a fundamentally different conversation to say we've got a company with rising earnings and rising returns that is trading at market average valuations. Can it keep it up? Versus having a conversation to say I've got a flat, stagnant business that's trading at a 50% premium to the market. Right? Those are totally different conversations you're going to have with an analyst, with your team internally when you're doing research.
Valens Research, the world's leading source for uniform financial analytics.